Hello, everyone. I welcome you all to the final episode of the Unoriginal series by Bhavin Gandhi. Welcome to the show, Bhavin.
Thank you, Pragati.
So, over the past few episodes, even though briefly we talked about, quite a few fundamental topics, such as, valuation metrics, how to look at PE and PB. But I know that there is extensive discussion around the industry around these topics, but what personally stayed with me is your approach to these topics. How one should not look at valuations in isolation, and that how every business, even though defensive, they are cyclical in nature. So in this episode, for the last topic, I want to talk about with you from your book on a very niche topic, which is not as talked about as fundamentals, that is position sizing. So, Bhavin, from what I gathered when I was, going through your book, is that when you talk about this topic, you keep it as important as ideation, right? So, however, you say that however concentrated or diversified one's portfolio is going to be, that, you should still keep still keep the idea of position sizing central to the portfolio construct.
True.
Now, this particular idea, it brings me to my very first question. How would you define position sizing first?
Sure.
And why do you think it matters so much?
Sure. So, like you mentioned, Pragati, I think a lot of time and attention is actually spent on deciding what do you need to buy, right? So, all the conversations within the investment team also is around what do you buy. So, the analyst who is not managing a fund is also kind of thinking all the time about which is the idea which is looking most promising at any given point in time, and he doesn't really need to think about how much should that idea be as a part of the portfolio. And I think that's the job of the fund manager. A fund manager, I think, should be spending as much time on ideation as he's spending on sizing. So sizing deserves almost equal attention in my mind as does the ideation bit. And the reason why this is important is, think about this conceptually. A 10% idea which delivers a 20% return actually gives the same portfolio outcome as a 1% position, kind of doubling, right? So most of the times we focus on which will be the next multi-bagger idea. However, if you were to size an idea correctly, the portfolio outcomes could be very similar, even if it's not a multi-bagger, right? So that in essence is the reason why sizing becomes extremely important. Uh, so that again, you can think about sizing in multiple ways. So sizing can be thought as, let's say, how much do you think you can lose on one particular idea, and that depends on how diversified or concentrated a fund is. But how much capital can you afford to lose on one particular idea will theoretically define the maximum weight that you can allocate to any given point in time to one particular idea. But there are various other ways of thinking about sizing, and I'm not sure whether the audience is aware, but there's a very scientific way of doing this. This is called Kelly's sizing formula. It's nothing but a very simple adaptation of a risk return frame, where you think about simultaneously about how much is an upside in a given idea and how much can you lose if the odds move against you, right? So you have to not only think about the upside, but also think about a downside if the macro turns against you. So that's at least how I think about sizing, and we can discuss this more at length. But sizing, it, according to me, is very, very integral part of fund management, and I don't think enough attention is paid to sizing decisions as much as people think about.
Yeah, I think that was quite a bold statement to make when you said that, sizing is as important as ideation, and people only talk about like what to buy, but how much to buy.
Sure.
But Bhavin, I mean, correct me if I'm wrong, but do you think that it is only in hindsight when you talk about, taking a 1% position which doubles, or probably taking a 10% position which only like, grows slightly more? So I think that is only in hindsight that you can make that decision, and also it happens in stages, right? Like how you mention in your book also that there is a phase one when you think that you discover the knowns and the unknowns, right? And how do you, like, are there any frameworks that you can like particular point to, that how do you think about sizing?
Sure. So if you can move to slide number 2 directly, you can switch to slide number 2. Um, so uh, if you can, if one looks at this, I mean, its slide seems a little busy, but let's not worry about the whole slide. But I just want to drive home the point that one way to think about sizing is that you think in scenarios. The company can have multiple what we call alternative histories, right? The macros can always turn against you. You might be working with certain macro assumptions, but that might change, right? You are in a very fluid environment anyways. So what I want, at least what I expect of the analyst, is that rather than giving me a single target price, right, which is based on certain set of assumptions. Let's say his assumption is that crude goes back to 85, interest rates were to stay at a certain level, and that is the basis of him giving a certain target price on the stock. I want to think, I want him to think in other scenarios also. Let's assume that the conflict that we are ongoing, the ongoing conflict gets extended, crude remains elevated for an extended period of time. What happens to the P&L? What happens to the balance sheet in that environment? And in that case, what should be a fair value for that particular stock? So then, at the minimum, what I would expect for the analyst to do is give me three scenarios. One is a bull case outcome, one is his base case target price, which he anyways gives me, and one is the worst case outcome, where all the macros are kind of going against you. In that environment, what is the downside? And if the downside that he's kind of envisaging is something that I cannot afford, right? Yeah. That is an idea not worth looking at. So for what I want to do is just think about this in expected value terms. If I assume that there is equal probability of all these three scenarios playing out, there is bull, bear, and base, and if I have a negative expected value, right, I don't want to be invested in that stock, right? But there are situations, and you will find plenty of opportunities if you are patient enough, where the stock is kind of almost discounting the worst case, where you can lose very little. Makes sense. Even if the macros are very adverse for that particular stock. That is the idea that I want to really double down. So basically, that is how I think about sizing. I think in expected value terms. I think probabilistically what happens in the bull case, base case, and bear case. And the bear case also doesn't lead to a significant downside from what the stock prices are today. Then it's a bet that I want to take on. Right. So let's say anytime I'm investing in a new idea, I'm looking for a 2:1 bet. Say a simple hypothetical case, that the stock would have a 20% upside and a 10% downside. But think about alternative scenarios here. You can have stocks which have 40% upsides, but in a node you can lose 20% capital. That is also a 2:1 bet, but that is a bet that I would not want to take, because in one node I can lose 20% capital. Now, that is something that capital protection for me is integral part of a fund manager's process, and I would not want to lose that kind of capital on a single idea. So that is, even though it's a 2:1 bet, that's not an idea which is good enough for me. And what this sizing frame does is, as the stock price moves against you or is moving in your favor, the story that you thought is kind of playing out, it will automatically lead to rewards becoming adverse for you, in which case you will automatically start downsizing the stock in your portfolio. Okay. So it's not only, it kind of starts mitigating the risk that you have in the portfolio when you are dynamically thinking about sizing in the portfolio construction. So when you say that, as the story is playing out for you, you mean that as we are moving closer to the target price, we start downsizing also. So what happens is, in that case, let's say the stock, you had a target price in mind, let's say a fair value of 100, the stock is kind of approaching that. Correct. And probably exceeding that and moving towards the bull case outcome, the expected value starts to become negative. You get it, right? Correct. Because the worst case becomes more adverse. In the base case, you don't make any money, and only in the bull case you will probably stand to make money. In which case, the expected value starts becoming trending towards a negative expected value, right? Which means that you need to downsize then. And when you do a similar exercise for your benchmark or the stocks in the portfolio, it constantly is telling you. Now, this is not something which is cast in stone, right? It doesn't mean that, let's say, my portfolio sizing is telling me that a certain position should be 2% of the portfolio and it's 1.5%, I'll not change anything. But if it is telling me that it should not be a part of the portfolio, it's showing zero allocation, and I have a very large allocation, it forces me to think as to why am I holding this, right? It's constantly just directing me that the outcomes probably will not be great from here, and that's why you need to resize.
Okay. I think, Bhavin, we have established that, it's not fair to think only about the upside and isolation, and we also, like account for the possibility of a downside.
Sure.
I want you to like, go deeper in detail of how position sizing essentially solves for that.
Yeah. So there are two ways, like I told you. One is that it is a risk optimizer. As the portfolio risk is kind of increasing, you are kind of downsizing the risk because you are cutting the position that you have. The other way to think about this is, if you can move to the slide number 3, what this kind of does, what the sizing framework does for you is that it also helps you. So Howard Marks says that risk to him means that more things can happen than will happen, which means that if the variability of in a given investment is very high, the sizing should be lower because you have multiple outcomes which can play through for a given stock, right? So that is what he means when that is what he means when he says that when the variability is high, the sizing should be lower. Sizing framework does exactly that for you. Let's say a stock has a very narrow set of outcomes, right? If it's a large liquid name and you know that there are very narrow set of outcomes that the stock can go through, it can automatically become very large part of your portfolio because the set of outcomes that it can go through are very narrow. Whereas if you looking at a commodity stock, or for that matter a small cap stock with a weak balance sheet, then it can go through a very wide set of outcomes if the macro turns against you, right? Because it's not only the P&L that is getting impacted, but also cash flows in the balance sheet, right?
Exactly.
In which case the outcomes will be very wide. In which case the sizing framework will automatically restrict the size that you can have for that particular idea. Like I mentioned, a 2:1 bet. I want a 2:1 bet, but there are bets which can have 100% upside and a 50% downside. Those are the bets like roulette. I don't want to take those bets. So in that kind of nodes, the sizing framework will automatically reduce the size that you can have of that particular stock in your portfolio.
Okay.
So that is how it is both a return optimizer, in the sense it is telling you that some stock is already approached its expected value, and there are other parts which are a part of the benchmark, which are kind of where the risk reward are very attractive at this point. So you can always think about switching.
Correct.
And it is also a risk mitigator in some sense. When the variability of outcome is very high, it will automatically reduce the sizing of that stock in the portfolio.
Correct. So what you mean is that you're okay with having limited upside, even if that means like that should mean that there is no downside, but you might not want it to be the stock to like double if the downside is like 50%.
Yeah, so I would not chase a given multi-bagger
Okay.
if in any given node I can lose significant amount of capital on that idea.
Correct.
That is a bet that's not
for
worth
you.
taking.
Makes sense. And also when you quoted Howard Marks,
Yeah.
can I interpret that risk is something that you have not accounted for?
So this is the unknown bit,
Correct.
which is always there. So that is why we always seek margin of safety.
That is what you account for in your scenarios also, or you
No,
don't?
so unknown is something that you can essentially not capture.
And that is what you call risk.
That is what is risk. That is, I would, for risk, for me means that there can be a permanent loss of capital.
Okay.
For me, and there are two ways to thinking about risk. One is that, like Howard Marks says, more things can happen than will happen, which means that the variability of outcomes can be very wide.
Correct.
The other way to think about it is a permanent loss of capital. That again is a big risk that I have to think about. So both these are for me good definitions of what risk means.
Okay. And also, my final question is, do you think that sizing is only a risk mitigation strategy?
No, like I explained, it's also a return optimizer. It is a return optimizer because it's sometimes will so happen that the stock has moved very swiftly and the risk rewards have become very adverse now. And because you have made so much money, there is always this, uh, you know, uh, averseness to sell that idea because we made so much money on that idea. But the risk framework is the portfolio sizing framework is already telling you that it should not be a meaningful part of the portfolio, where it will be continuously also showing you parts of the benchmark which are very attractive on risk return terms, where there are ideas which are a part of the benchmark where you can lose very little capital and can make a lot of money, right? So in some sense, it's kind of forcing you to move towards that idea, right?
Correct, correct.
So that's also kind of enhancing your return. So it's sometimes also a return optimizer.
Makes sense. Now, I will take a few questions from the
Sure.
audience also. So, what are the most common position sizing mistakes you see retail investors make?
So again, like I mentioned, the most obvious mistake is to think about only upsides and not
Okay.
about downsides.
Right.
And that is where most accidents happen. People just look at, possibility of a 50, 60, 100% upside and just forget about what can happen in a downside. So if like in a given environment, if you are just focused on the P&L and not so much on the cash flows and the balance sheet, and if the balance sheet gets impaired, you will have a permanent loss of capital on your investing company. So that is where I think a lot of retail investors tend to lose money, where they focus on upsides, focus only on P&L, don't focus on the balance sheet, etc., and don't look at the strength of the balance sheet and whether they can stand through the tough times and survive the tough times. If you don't survive the tough times, you will lose capital on those kind of things.
Sense. I want you to be very candid for the next question I'm going to ask. What's one mistake in your own career around position sizing that taught you a very important lesson?
So again, it was something. So what we try and do, right, is work with scenarios like I mentioned, and we look at the worst case, a base case, and a bull case. But there are, like you mentioned, unknown unknowns,
Correct.
right, which you did not think of, and that is the kind of outcome which actually played out, which is even worse than your worst case outcome, right? And you thought that you can't lose any money on this name because it's already approaching your worst case outcome. But then the unknown risk kind of played out, which you did not think of. And the worst case was even worse than what you thought is likely to be the case, and you invested in that idea.
Correct.
So there have been, some names which caught us by complete surprise, where we did not think that something worse than we already were thinking can happen
Accounted.
to that name, and it did play out in that way, and we lost. I mean, if you had thought through enough on a given idea, we will not lose too much capital. But there have been instances, one or two instances, where we have lost capital because that unknown kind of played out, and which we did not think of.
Also, Bhavin, do you think that, in the past 2 years, whatever happened around the geopolitical tensions, around the tariff war, around the US-Iran war,
Yeah.
was it like an unknown risk you were talking about that played
Yeah.
out in our portfolios?
Yeah. So these are, so think about it, from last 1.5 year, you have three such events, right? You had the Indo-Pak war, then you had the tariff situation, and now you have the war. You did not anticipate that all of these three events will play out in a single year, right?
Correct,
So
correct.
this is in some sense that unknown that was I was talking about. The only thing that you could have done in or you the only prepared only thing that you have done in a preparation is that at least have companies which can survive that one year, have the balance sheet to survive those tough times. And in that case, hopefully, when the things improve, these companies will come back.
And also, will that, like now, like how in the past 2 years, so many things have happened. Do you think that will make your scenarios more conservative now, or probably like you think they were already conservative enough?
No, so basically, I don't want theoretical bull case outcomes. Sometimes analysts just use Excel models to think about bull case outcomes. That is not something that I usually rely on. What I So, for example, when I think about this worst case, base case, and bull case, I want the analyst to look at the company's own history. And if there is no precedence there, then look at similar companies in the same sector and see their long term histories and what has happened.
Makes sense.
And in that eventuality, where what have been, let's say, a 3 year rolling revenue growth, margin profiles, etc., when you look at the company's actual history and then think about what are you forecasting, it makes much more sense, right? You just don't do your Excel analysis in complete, you know, without looking at the history of the
Absolutely.
own company. So I think our scenarios are always very realistic. But yes, you can have surprises there as well.
Yeah, like you talked about in one of the episodes about how we should think about, where we are in the cycle
That's right.
instead of.
That's right.
Okay, so if you had to give one position sizing rule that every investor should follow regardless of regardless of experience level, what would it be?
So I would say that look at, let's say, look at the 10-year history of the company, okay, and look at your investment horizon. Let's say you are investing with a 3-year horizon. Look at a 3-year rolling financials of that company, right? And you might never know that the worst 3 years outcome might still play out for the company in the future 3 years outcome, right? And if those situation, if that kind of situation was to happen now, how much money can you lose on that name? And if you think that that is the loss that you cannot afford, then you should not be investing in that idea.
Okay.
You can only, you should not, the first thing that, I mean, like one of our co-fund manager, Abhishek Singh, always says, nobody knows, right? You can always have surprises. So should always protect your downside. You shouldn't lose your capital in any given idea. So the first thing to think about is how much can I lose on the name, and then think about how much can I make.
So
Downside protection is key.
very important.
Yes.
It's a very interesting question, actually. Should sizing be decided before you buy it, or is it something you build into over time? I think we talked about it also.
So, build or something that gets built over time is something that does not have a long history. So if the company is, if the company is, the business model itself is very nascent, in which case you will not have a long history. Otherwise, even the business is relatively new listed, you will have at least the templates for looking at similar other companies in the same sector. In which case, sorry, I lost the track. What was the exact question?
That should it be decided before you buy the
Yeah,
position or
absolutely.
during
So
it?
at least you should have your scenarios beforehand available to you, because you will always have a hindsight bias otherwise.
Correct.
You will change the narrative. You will, if you don't document why did you buy, what was your first worst case outcome, that you, when we are investing in the name, you will always tend to make the scenarios more favorable after you invest in the name. So I what I always tend to do is have my scenarios beforehand, before I'm looking at investing in a given name. But there are occasions where you know very little about the business, in which case either I don't invest, or I invest a very token amount, develop my understanding, have my scenarios, and then build the position.
Makes sense. Also, so you're saying that as you move through different price targets in different scenarios, you build on your position and you write your rationale around
Yeah.
it.
So generally, the rationale has to be done beforehand. I mean, it's otherwise you will always get, you will always have this hindsight bias, and then that is where the most accidents tend to happen.
Okay. So we have this one last question. You can also skip to answer this because this is from one of our previous episodes.
Yep.
Please explain your expectation investing framework and how one can practice this. You can probably like explain it in a very
I think
brief.
we have the recordings of these
Okay, yeah,
sessions available.
we
We can
can
always go back
go
and
back
refer
to
to
it.
it.
Okay. So I think that's it for
Thank
this
you.
episode. Thank you so much for joining us. Thank you so much, Bhavin. It
Thank you
was
so
really
much.
a treat. We will catch you later. All right. Thank you.
Thank you.
Mutual fund investments are subject to market risks. Read all scheme related documents carefully.